Welcome to our Hurst Cycles webinar for the 17th of October 2016. As always, before we start speaking about the markets, I must ask you to please read and make sure that you have understood these disclaimers. I'm delighted to welcome on today's webinar a guest that we've had before, John SilentOne, who I have introduced before, but for those of you who haven't met John in our previous webinar, John was one of the very first people who started working with Sentient Trader when I started developing it and put it up on a website. In those days it was called the Hurst Trader. And John was one of the very first people to get involved with helping to beta test the software, and was very instrumental in shaping the software and what it does. He's an extremely experienced Hurst Cycles analyst, somebody whose blog posts I have followed for many years, and he is particularly experienced at analyzing gold and the precious metals. Not only does he analyze them, he also trades them. And whenever John has anything to say about gold or about silver, I sit up and take notice, because his advice about the precious metals markets has an uncanny knack of always turning out to be true. And so I'm delighted to welcome him onto today's webinar. A little bit of sort of the background to today's webinar. John recently gave a presentation to the Canadian Society of Technical Analysts about gold, and when sharing the content of that presentation with me, I asked him whether he would be okay with coming onto a webinar and sharing the contents of that presentation with our community. And he's agreed to do that. So hello, John. Thank you very much for joining us.
Yes, good.
So let's start with this slide here, which discusses your preferred approach to gold cycles and speaks about the different ways in which you like to analyze gold, the metal, as opposed to the gold mining companies. Would you like to say anything about that and why you're taking the two different approaches?
Right. So first, we should understand that this view and this approach is based on some long-term data analysis. In the case of gold, using data back to 1970 roughly.
Okay.
And in the case of the gold miners, it's based on the Barron's Gold Mining Index, the BGMI, which is based on about 75 years of data. So the how I arrived at sort of this model is that I'm using Sentient, and I've used its initial cyclic model setting to help me identify those cycles.
Right.
And then then we're looking at some long-term graphs, which we're going to show shortly. But in the case of gold, much prefer a peak-to-peak analysis as a primary view, and I think you'll see quickly why in the charts. And in the case of the gold mining companies, I prefer trough to trough. And to explain the difference in the case of gold acts a little bit different than stocks. In the case of the metal, people tend to buy the metal on fear,
Right.
and greed, I guess, and you see these important spikes in gold that become meaningful peaks, and they give you a very a very regular type of cycle period. Whereas on the gold miners, they tend to act a bit more like stocks.
Yes.
And I think you do better working on a trough to trough analysis with them.
Yeah.
The only other thing I want to point out here is there's a subtle difference in the cycles. I find with gold, I've sort of leaned towards a 2-to-1 harmonic right through all the cycles, if you notice them.
Yes.
Whereas
Right.
with the gold miners, I prefer when you get down from the roughly 4-year or 45-month cycle, I prefer a 3-to-1 harmonic because it's a little bit closer to what you would find for stocks.
Right. Okay. So
And
yeah.
that's the main difference.
So that's the big difference between the nominal models that we're using. So for those of you who are new to Hurst cycles, I know that some of you are new to Hurst cycles, and just so that you understand what we're speaking about, a nominal model is really simply the list of cycles that we use to analyze any particular market. And so in the nominal model that John's been using for the analyses that we're going to be looking at, you can see the longest cycle in both of these nominal models is the 15-year cycle over here, 15-year cycle for gold and for the gold mining stocks. Then there's a 7.5-year and then a 45-month. So up to that point, the nominal models are the same, they're matching. But then once you go shorter than 45 months or about 4 years, in gold, John is working with a 22-month cycle, whereas in the stocks he's working with a 15-month cycle. So that means in gold, in terms of the peak analysis, you're looking at a 2-to-1 harmonic ratio over here, because of course there are two 22-month cycles within every 45-month cycle, whereas in the stocks you're looking at a more conventional or standard 3-to-1 harmonic ratio at that point in the nominal model, which is of course the nominal model that we work with generally using stocks. And John mentioned that he discovered this nominal model by working with Sentient Trader's initial cyclic model. And what happens there is Sentient Trader, when it first performs an analysis, does a very rough form of spectral analysis, using the same spectral analysis process as a matter of interest that Hurst used way back in the 1970s or late 1960s. It uses the same spectral analysis process to try to determine where the greatest likelihood is of the cycle wavelengths. And the initial cyclic model will give you some indication of what cycles it finds in the market. So that's the process that was used there. And of course, a very interesting concept that gold has synchronized peaks. The cycles that move the price of gold have synchronized peaks, and the prices that move the gold mining companies, because they are stocks, have synchronized troughs. So it's an interesting concept that we've spoken about before. So let's move on and take a look if I can find the right button. So here's an analysis of gold using Schelling's data back to 1970, and this is, of course, working with a peak analysis, isn't it, John? So do you want to say something about this analysis here?
Yeah. So we will look at gold first and deal with that, and then we'll follow that with the gold miners.
Right.
But this analysis is showing clear peaks from 1980 onward.
Yeah.
And the cycles, bear in mind, most of this period was actually in a bear market, but the cycles, I'm sure you can barely see them. They're listed on the right side. There's a roughly just under 16-year and an 8-year, and then something close to 45-month cycle that's listed on that. And that's what Sentient has found, with this data. And you can see the peaks are fairly regular. And very identifiable.
Very,
so
very
from 1980, you're going to a peak in 1987, then to 1996, to early 2004, and then of course the peak in 2011.
Right.
And then in amongst that, you have a 45-month cycle, and it's interesting that the 45-month cycle, it's hard to identify that peak. I think Sentient has trouble identifying that peak, but it actually, for me, the peak comes early, as it should in a bear market. So even though it's showing the 45-month cycle peak sort of in the middle of those 8-year periods, it's actually, I think, more to the left side of each interval. until it gets to the bull market phase.
Right, right.
And on the bottom, we show David's cycle lines this feature that he's added to SilentOne, which I really like because it helps you visualize what the different cycles are doing.
Right.
And so you can see the simultaneous peaks of the 15-year and the 8-year cycles. When they both peak, well, you can see how that would mean that you're getting a peak in the 15-year cycle, that synchronous peak. And I think everyone has to understand that those cycle lines, all they do is basically work off of the Hurst diamonds, or the location of the various cycles that are identified by the software. So you have to bear that in mind.
Yes.
I don't know if you want to talk to that at all, David, but
yes,
I think it's
absolutely.
an important point to understand.
Yes, yes, I think it is. It's a very important aspect of these cycle lines. So let me just clear all these scribbles that I've done on the chart. So these cycle lines that you're seeing at the foot of the chart are, as John mentioned, one of the new features in version 4 of SilentOne Trader. And what you can do is you can plot the lines which indicate the way in which the cycles are influencing price movement. So, of course, when the line is moving up, that means that that particular cycle is influencing price to move upwards. When the line is moving down, it's influencing price to move downwards. The amount by which it moves up, the sort of height of this move, is the amplitude of that cycle, and so those cycle lines make a very useful way of visualizing what the analysis has given you. But as John mentions, it's not a separate analysis that has been performed on the data. It is simply a different way of visualizing the analysis that you have. And so, of course, these cycle lines form peaks, when the peaks are found in the analysis. So it's no surprise that you're seeing simultaneous peaks, okay, between the cycle lines and the analysis, because the cycle lines are derived from the analysis. So they just make for a different way of visualizing the analysis that you have. And one of the things that I find very useful about these cycle lines is that you can understand why, for instance, peaks of this cycle over here, that's the 7.5-year cycle. You can understand why that peak was really not a very big event in terms of sort of looking at this chart. It's not nearly as big an event as this peak over here. And the reason for that is because these cycle lines are moving in opposite directions, which you can see very clearly here. The 7.5-year cycle line is forming a peak, of course, at that 7.5-year cycle peak, but at the same time the 15-year cycle line is forming a trough, and so you get that contrary movement from the two cycles, and because of that contrary movement you don't get very clear signs of that peak forming in the market. So I hope that makes sense. I see Surrender Badesera says not getting our voice clearly. There are two of us speaking. It's myself and John. So we're trying to balance our voices. So we'll try and speak a little louder. I have a habit of
being a duo.
Yes, I have a habit of shouting into the microphone. I'll try not to do that. Najmuddin says the cycle lines are the decomposition of the composite model line. Yes, Najmuddin, they're not so much the decomposition of the composite model line. They are, in fact, the sort of a step in the process of creating the composite model line. So yes, they are the decomposition of the composite model line. They are the information that is used to build that composite model line. Okay, it's the cycle wavelengths and the amplitudes as measured using the processes that Hurst himself in fact discussed in terms of measuring amplitude. Piotr has a question: how to explain 1996? 1996 was this peak over here. in terms of explaining it, Piotr, do you mean why, if it is a 15-year cycle, it isn't as prominent as this cycle in 2011 or as prominent as this cycle here back in 1980? The answer to that, I believe, is probably something that we're going to be getting to later, which has to do with the next longer cycle. You must remember that there is always another longer cycle because there are an infinite number of cycles. So just when you think you've considered all the cycles possible, there is going to be a longer one. And possibly the next longer cycle is a 30-year cycle. John's going to have something to say about that later. But if it is a 30-year cycle, then it seems likely that the 30-year peak was here in 1980, and the next 30-year peak was here in 2011, and therefore this 15-year cycle peak was less impressive in 1996 because it was the in-between 15-year cycle peak. It's not a 30-year cycle peak.
Actually, I probably want to add to that, but definitely the 30-year cycle is the reason why 1996 gave such a insignificant peak. But one thing you'll notice in the analysis and in the cycles, and I'm sure this is not just with the precious metal market, but when you analyze the peak analysis, you're always, what always has to happen is a very large cycle typically peaks out before a major trough follows. So imagine, whether it's a 7-year cycle we're talking about, a 4-year cycle, there always has to be a fairly large or significant cycle that, the next one down, say, has to be peaking out to give you the following important trough.
Right.
And that's basically what you see. I don't know if I've explained that properly, David, but I'm sure you get my sort of interpretation there.
Yes, yes. I think I understand what you're saying. That although both of these cycles are peaking here, there's potentially a longer cycle which is coming along here and is forming that trough like that.
Right. So to get the 30-year cycle bottoming, you have to first see a 15-year cycle peak.
Yes.
To set that up, and it works whether you're looking at the 7-year and a 4-year cycle has to peak prior. It's always sort of the same look, and that's what you're seeing there with 1996.
Yeah. Yes. Yes. Exactly. So I'm going to mention cycle shapes. I can't resist mentioning cycle shapes. But when you're looking at a peak analysis, of course, you expect the cycles to create W shapes. So you get a move down, then a move up, then a move down, and then a move up. And so, of course, this central one here tends to be less impressive as the ones to each side of it. Hopefully that explains that. Shall we? Let's move on and take a look at the next slide and discuss that, which is, let me see if I can find the right button. There we go. So this slide summarizes a Hurst cycle status, if you like, in terms of what gold is doing. So you can see the summary of the status is that gold formed a major low in December of 2015, possibly, as John says, a 15-year low. And in fact, if you'd been on our webinar, when did we do that webinar? Was it in October or early November?
I think it was around September or October.
September, October. John spoke about gold, and that was exactly what we were speaking about, was the upcoming major low in gold. And John was saying stand by for a very important low, and of course that low came in December 2015. The next comment is that the gold miners, and those are the instruments there in brackets, made an important low in January 2016, a 7.5 and a 15-year cycle low. And so you have a difference in the analysis, of course, with gold and with the gold miners. because as already mentioned, gold we're analyzing with the peaks, and the gold miners we're analyzing with the troughs. So you have a little bit of a sort of a staggered trough that formed, the 15-year cycle trough. Gold then stalled in July and August on its at its downtrend line from 2011, and so we'll show you that downtrend line in a moment. And so, John, what you're saying here is that we're expecting a retest of the lows. In other words, gold is going to move down and might retest those lows, or it'll form a higher low, which should happen by early 2017, so within the next few months. After which the peak analysis projects a 7.5-year cycle high in 2018 to 19. I think I'll move on because this chart shows that visually.
Right.
So here we have gold, and so let me just turn on this pen. So we're looking at now gold retesting the lows with this move down, and you're expecting either a retest of the lows down here or a higher low, and that should happen within the next few months by early 2017. And then we're looking at a move up in terms of the gold price up to 2018, 2019. Which is this peak over here. Is that correct?
Yeah. So, the first thing I should probably mention about this analysis and what has made analyzing gold a little tricky is identifying the 45-month cycle peak.
Right.
And it is, it's actually, I think in this analysis, it's actually pinned. And that is, early 2015. And, honestly, that one feature pretty much drives this analysis. I'm
right.
getting more confident about that. I really wasn't sure where the 45-month cycle peak was, with my analysis earlier in the year, but
Yes.
I'm becoming more confident about it now.
Yes.
And so if you can imagine, if that was the 45-month cycle peak, then, the summer peak, even though it was a little less than, it was less than 22 months, I think it was an important enough peak that that was likely what we saw, even though in this analysis, Sentient hasn't pinned that, hasn't, given it. I think as we progress, it'll become more obvious that was a 22-month cycle peak.
Right.
And obviously from a larger cycle like that, you're going to get a pretty good correction, which is what we're seeing now.
Yes.
And now we're going to see pretty much how bullish or not bullish the gold cycles are, because in the coming 2, 3, 4 months, a good low should be forming.
Right.
And that will be setting up the next leg up into the peak that we're looking for in either 2018 or 2019.
Right. Yeah. So we're looking at.
And
sorry, John.
yeah,
Carry on.
I think I'm not giving a lot of detail in that analysis. I'm just showing the general concept and the general idea. We're going to get into a finer detail in the next few charts. But again, you can see the concept that we made a very important peak in 2011, and
Yes.
now we're setting up for a run into an important peak, the next 7.5-year cycle high, which should be coming within the next couple of years, I would expect.
Right. Right.
All right.
Yeah. So the important point is there's the really, really big high, and we've had to move down, and now we're looking at more of a correction coming up.
And on that, on that point about locating the 45-month cycle peak,
yes,
I looked at the data back to 1996, and that cycle, it gave different cycle periods. So 48, 50, 47.5 and 42 months for an average of 46.9 months.
Okay.
So one of my concerns was that the peak we saw this summer was a very extended 45-month cycle, but that summer peak would have meant almost 60 months
Right.
to the 2011 peak, and I just don't think that works. And
Yeah.
I think that's why I lean to the analysis that's shown.
Okay. Yeah, because when markets move fairly concertedly, not necessarily strongly or steeply, but when they just sort of keep moving in one direction, it can be very difficult to identify, the correct peak out of the sort of options that we have available to us. Just as it can be difficult to identify troughs when a market is rising. So that's an
Yes.
interesting point that this analysis
And
is
to
based on
just
that
to
fact.
add, yeah. And so one final point, and this goes back to the slide before and what we were saying, that you have to have a significant cycle before you can make a trough of the next larger cycle.
Right.
So in this case, you needed to have a 45-month cycle peak, ideally, that arrives, before the setup for a 7.5-year cycle trough.
Yes.
And in this case, it just happens to also be
Yeah.
the trough for the 15-year cycle,
Yes. Yes.
right?
Right. Okay. So
All
let's
right.
move on and take a look. Oh, perhaps just one other thing to say about this chart. We're looking here at the composite line, which is not a magical line, but what it does is it takes the cycle information that it has available to it, and it makes the assumption that the cycles are going to keep beating with the same amplitude and the same wavelength. Actually, that's not quite true. It makes the assumption that the cycles are going to return to their average amplitude and their average wavelength that they have been beating with. So it gives you a projection of what to expect. Again, it's just another way of visualizing the analysis that you have. So this analysis, if you're not used to looking at all these triangles and circles and whiskers and so on the chart, this composite line tells you at a glance what the analysis is telling you to expect, which, as John has mentioned, is a declining market until early 2017, and then we're expecting this move up here into the 7.5-year cycle peak. So let's take a look at our next slide. Here we have a bit more detail, and we have the trend line over here, that trend line over there, which provided.
So that's not necessarily, well, it coincides with the 45-month FLD, but I wanted to show the trend line as well.
Right. Yes, so price came up in
So you
in
can
July,
you can
August.
see where the 45-month FLD is the dashed line.
Okay.
Right, the orange dashed line.
Yes, right. And so that provided a sort of a stopping point for the move up in July, August, and now of course prices coming down. And here we have this dashed line here is a VTL, which I think we're going to be looking at in the next chart, aren't we?
Right, that's what I meant. VTL.
Yeah,
Sorry,
yeah,
David.
yeah. So
So
yes,
I was just going to say that it's interesting that gold now is sitting in this triangle, and triangles are very important. Hurst often talked about triangles,
yes,
and essentially, I would be looking now for confirmation that gold is bullish and breaks up out of this triangle.
right. So having come down a little more, we're still looking for a breakup above that trend line.
Yes.
Yeah, okay, great. Let's move on and take a look at the next slide. Here we go. Okay, so now we're taking a different approach. Do you want to introduce this, John? Tell us what we're looking at here.
Yeah, certainly. So, fellow Hurst analyst William Randall, who has often posted his work. It's a bandpass filter look at different markets, and his work has been quite helpful to visualize and confirm, what we see with our sentient analysis and
Yeah,
our, basically our view of a market. So I'm not an expert on bandpass filters, to be honest,
yeah,
but I think that his work is really helped me in understanding the S&P better,
right.
and the cycles that seem to be working, and also for gold.
Okay.
Um, maybe you want to just say a word about the bandpass filter before I get into any kind of detail of what's shown here.
Yes. Okay. So I'm also, I must say, not an expert on bandpass filter work, but it's um, uh, in Hurst's book, The Profit Magic of Stock Transaction Timing. He showed various charts that used bandpass filters. They are filters used. They're mathematical filters, of course, that are used to run data through, and they're very useful for extracting information about cycles. And so, as I understand the results of a bandpass filter, when you get these sort of high peaks, then that's an indication that that particular cycle is has risen up to a peak, and then it drops down again. And so, a bandpass filter is a way of not performing a Hurst phasing analysis, which is what we do with Sentient Trader, which is more of a sort of a visual approach. A bandpass filter just runs the data through these filters and extracts information about what each one of the cycles is doing over time. And so it's fairly self-explanatory. I think you can see how you get these very nice even lines at the foot of the chart showing what each one of these cycles is doing. So for instance here the 23-week cycle is busy coming down. As you can see over here with that red line, it's coming down and is expected, of course, to form a trough soon. And the 22-month cycle down here has turned down. You can see that little bit of a red line over there, indicating that the 22-month cycle has turned down recently and is also heading down towards the trough.
So, should probably add, some other comments from William, in that he really likes the 23-week cycle. I
Okay.
think it's the impression that's the cycle he likes to trade. I certainly follow it. Don't always trade it, but it's the one I would be looking to trade if I were to trade long. And he mentioned that, yeah, 23 weeks, that's been the average for the last 8 years or so.
Wow.
So it's been a fairly consistent
Yes.
cycle to follow.
Yes.
And the second thing is the idea of following gold with a 22-month cycle. I basically got that from William and his work, because it was in his earlier charts that I noticed this 2-to-1 harmonic to the 45 cycle, and it
Right.
was this analysis that kind of got me thinking about it, and now it's the one I use, and it's the one I prefer.
Right.
And you can see that where that 22-month cycle peaks pretty much coincides with the analysis that I show for gold, where I'm
Yes.
looking for simultaneous synchronized peaks, and the examples are 2008, and then synchronized for the large cycles in 2011, and then it came early in 2013,
Right.
and that looks
Yes,
odd,
that
but
was.
that's really where the peak was for the 22, and very bearish, of course.
Yes.
And then trying to identify that 45-month cycle on down that tends to come either some point in mid to 2014 or early 2015. That's pretty much what it shows. It, as long as we know that that peak was roughly in that band, then we start to get confidence that the peak we saw in the summer here was a 22-month cycle, and sure enough, Williams' work is showing that yeah, that cycle did turn over, and it did give us a peak then, right?
Yes, yes. Okay. It highlights a very
So
interesting.
that's one of the neat things about Williams' work is that it gives you a different look and a
Yes,
different view, and more confidence in your analysis.
yes, that's right. It highlights a difference between the two analysis approaches, because Sentient Trader uses a sort of a visual pattern recognition approach where you're expecting a peak, and so you look at the different options, and you know, choose the best one based on how it breaks down into the smaller subcycles, whereas this band pass filter work just shows you where the peak it was expected to have happened as a result of the bandpass filter, and by comparing the two of them, you find two different approaches to identifying your peaks or your troughs, of course. Okay.
And I think the final point I want to make here, and this was also pointed out by William, that the arrows, the green arrows, give you the call it 7.5 year cycle, which is what I've identified and used, and the fact that the band, the envelope, if you will, is turned up, is confirmation that the sum of the cycles is up.
Yeah.
And
Yeah.
that's also an important point, and something that will give you some confidence that yeah, even though we're going to be making a low in gold here somewhere somehow, there is another leg up that prices should ultimately find a low and then start another leg.
Right. Right. So
And
we
then
are looking for it to turn up there. Yeah.
yeah, so and you can see that we're trying to hold the mid band on that envelope, which I doubt is going to hold.
Right.
Right? So, and there's nothing to say that it should hold. It's likely that, we're going to drift down and then we're sideways for a bit until, we catch or get support from that band,
Right.
and then the cycles start resuming their upward trend.
Then they start turning up. Okay. That's very interesting. So let's move on and take a look at this chart here. So this is much greater detail, and now we're combining the peak and the trough analysis. So here's our 45-month peak.
Yeah, so this is a little departure from, yeah. Yeah, so this is a little different from what we were looking at before, because before we were just looking at peak analysis alone. And I don't know what your experience so far is, David, but I find that if you can use the two, I think it gives you a more robust analysis.
Yes.
When you're looking at an instrument, and
Yes,
so
absolutely.
if we now look and see with the cycles that we follow, we are looking for a synchronous trough. If we were analyzing gold on trough to trough basis, that should form here in November, December. That probably is going to be the low. That doesn't mean it won't be tested again, but it's likely to be the low by year end.
Right.
And so this is something that I'm following very closely now. So I'm kind of standing by and to start looking for those long positions. And the issue is what's the target? Where is it going to go down to? And that's not as obvious.
Right.
I know from other types of analysis like volume analysis and such. I know 1250 is important support, but I doubt it's going to hold. And then there's another level, 1234, based on volume analysis, that's probably going to be tested. And then I would say even by the time we're done, it could even be 1200. So there is
Right.
there is some room here for gold to test lower, and at the same time though, I'm vigilant and watching very closely to see where this low forms, because I do think you're going to want to take some positions as we make those tests here by the end of the year.
Right. So we're looking for that trough. That's really the important point there. And shall we?
And
Yeah.
I guess we should probably just carry on to the next.
Yes, because this gives us a
slide.
great summary, doesn't it?
Yeah, and that is the cyclic status for gold. So based on the cycles that we mentioned earlier, gold now, I think it's fairly clear that the larger cycles are up. Even the 15-year, which I haven't listed, but the 7.5 month, 45-month cycles are pointing up.
Right.
In the case of peak analysis now, we pretty confident that the 22-month cycle was observed in the summer.
Yeah.
And that also means that the 24 and 48-week cycles are heading down, and we're looking for a low for those cycles. And then the trough analysis agrees pretty much with the analysis, except that the 22-month is probably topping out on the trough analysis.
Yes.
And will soon be rolling over.
Okay.
Right? Yeah. So that's the only reason why those are slightly different.
Yeah. So the only difference really between what the peak analysis tells us and what the trough analysis tells us has to do with the status of the 22-month. But that's what I find really interesting about combining the analyses. Once you get past trying to work out which analysis is correct, I think it's quite useful to look at both of them and see what information both of them give us. And the peak analysis is telling us that the 22-month cycle is moving down, and the trough analysis saying that it should be peaking, but probably because we have a peak analysis, we can say, well, it is probably moving down. So I think
too, the peak analysis is important, because when if you do cycles long enough and you look at the analysis long enough, you realize 22 months is a pretty big cycle.
Yeah.
So you don't want to be standing long
No.
as that cycle is peaking.
No, exactly.
If you understand me.
Yes, that's right. You don't want to wait for the peak, particularly in gold, which forms pretty sharp peaks. You don't want to be sitting around waiting for that peak. You want to be making sure that you're out before that peak happens, or as it happens, ideally.
Yeah, exactly.
All right. So shall we move on and take?
So I think now we're. Yep.
Yeah.
Let's move on into gold miners.
Gold miners. So this is the first gold mining index that we're looking at, Barron's Gold Mining Index. So what do you want to tell us about this?
Well, this data comes courtesy of ShareLinks. They have a nice data set that you can buy, and the weekly close, it's not daily. But the nice thing is it gives you some very long data, like a very long data set to analyze.
Yes.
And so now what we're showing here is I think we're 75 years of data, and Sentient has no trouble, interestingly enough, identifying most of these troughs.
Okay.
Maybe the only one that's a little muddy is the 1971 trough.
Yeah.
But you're getting very distinct cycles from this analysis. You are getting the 14.5 year cycle, and it's interesting that cycle, the range was I think 14 years to 15.3 over this period. So It's a fairly consistent cycle period, and the average being 14.5 years. And then if you look at some of the long-term analysis that I've done on gold and other things, I mean, it's just very, very, very consistent. And,
right.
So I would say it's something to pay attention to and something to follow, because if you're bullish, you want that cycle low behind you. And if you're bearish, well, then you want that in front of you. I think it's an important cycle to know the status of.
Right.
And so now in big picture, that long cycle is bottomed, and
Right.
we don't know how bullish or bearish the sector will be over this next 14.5 year cycle. But as we know with cycles, even if it is a bear cycle, chances are that market should be bullish for a period of time, at least a couple of years.
Yeah.
If you follow my point, David.
Yeah. Yeah. Absolutely.
Um,
We
yeah.
need to see the rise up, to give us our nice M shape. We had a lovely M shape over there, and so now we need a rise up. But as John is saying, we're not sure what shape it's going to take before the next trough. So the next trough might end up down here, or it might be bullish, it might end up there. But we definitely are looking for a good move up for that 14.5 year cycle at the moment.
One thing I'll add, and you know, one thing I want to add here as we look at the long-term view, I think a lot of comparisons will be made to the bear market for the sector in the 1980s and 1990s. And to be honest, I don't think it's going to be anything like that at all. My expectation is for a retest of the highs within the coming cycle.
Okay.
So what I base it on is how the sector performed in the 40s and 50s, and you can't really see it on this chart.
Yeah.
But basically it was range bound, but it was a fairly robust range, and I kind of expect the same thing to happen here, which give you some pretty significant moves actually,
Yeah.
over the coming years. But again, time will tell.
Yes. Okay.
So why don't we move on to the shorter time frame?
Right. Here we go. Now this is the Amex Gold Bug Index.
Right. And so I'm showing the gold miners with the Hurst price bars.
Yes.
And what I want to point out is the larger cycles. In this case, now we're down to the 7.5 year cycle, and you can see the phasing. You can see the Hurst diamonds.
Yeah.
And what we're showing here now are the three FLDs. We're showing and again, remember that the cycles we follow here are a roughly 15-month cycle for the gold miners, a 45-month cycle,
Right.
and a 7.5 year cycle, which is a little different from gold, if you remember.
Yes.
And so that's represented by the orange, yellow, and green FLDs.
Right.
Right. Okay. And the important thing I'm trying to show here is how price now has risen above all three FLDs this past year.
Yeah. Over here.
And that we are now seeing whether price is supported by this sort of I don't know how you want to call it, bundle of FLDs.
Yes.
as they've all squeezed together. But that's an important thing, and it's something that we need to see here, is that as the UE tests 200, and it can test lower. I'm expecting it, but we want to see some support come in here, within the next 10 to 15% down.
Right. Right.
And I want to see the 45-month FLD provide some support. And so it's an important point in time for the bullish kind of view.
Right. Yes.
And
Yes. Because those
the
FLDs need
other
to
thing I'll
provide
point
support.
out is, yeah, and I have highlighted the start of 2000 bull, and how price rose above those FLDs and stayed above them.
Yes.
You can see that transition, and that basically occurred where I've circled that point. And that's sort of the same thing that has to happen eventually here if we're in a bullish phase.
Right. That's right.
right?
The FLDs need to
And
provide
then
that support.
in the case of the bear market, the way that was confirmed is you can see how the shorter FLDs, the 15-month, and um, the 34-week FLD, it crossed down
Yeah.
through the 45-month FLD, and then price went with it, and that basically confirmed the bear phase of of what we saw in the last several years.
Yeah, that's right. I love FLDs, as you know. So here, price breaks down below the 45-month, the orange FLD, and then comes back with it and tracks up with it until it finally gives up the ghost over there, confirming the bear.
Yes.
And in fact, we've
Yes.
seen a very similar thing happen here, haven't we? It's sort of crossed up above the orange 45-month FLD. It's coming down with it now.
Yeah.
But at this point, what you're saying is we're expecting it to, instead of continue to find resistance at the 45-month FLD, we're expecting it to break away to the upside, at which time it will confirm the bear. And that should happen, the bull, I beg your pardon. And that should happen pretty much at the level of the yellow, the 15-month and the 48-week FLDs, that we're expecting them to provide support there as well. Pretty much as they did over here.
Now there is
yeah.
Now there is one other possibility that I haven't really addressed in the presentation, but I just talked to it, and that is, we could be entering sort of a sideways kind of market. We get stuck in a range until we can break out, and that might go on for longer than we might think. But if we break down below those FLDs, if you understand what I'm saying, David, if we don't find the support the way we did in 2000, then this market could sort of go sideways for a bit until we make that break higher into the peak that we expect.
Right. So there is the danger that it'll move sideways and then up.
Yeah. So that would still provide some good trades, but it would be, I think there would be a delay before we saw that market actually break up.
Yeah.
So it's something we don't know right now, but it's something I'm kind of conscious of.
Yeah. So certainly something
And
to
I
keep
guess
an eye on.
the one final point I'd like to make, the one final point I'd like to make, and it's a general comment about Hurst and how I view what should happen in a major bear versus a major bull, and it's basically the setup of these FLDs as I've shown them.
Right.
And if you look at, for example, if you analyze the S&P and you look at 2008 and how the market rolled over, well essentially what really confirms a major bear is when the price get low all through those FLDs.
Right.
And if you can see how that is set up, with the price action, and once that happens, it basically stand back because that market's now getting in a very strong position to go, in a certain direction. If you follow what I'm saying, David.
Yeah.
It took time for the gold market to top out, and the miners were setting up a very bearish pattern. And once those FLDs get set up and price is caught below, the green, yellow, and orange FLDs as shown, I mean, that's it. You are riding that down until you finally find a low.
Yeah, that's right. So you see it here in 2000, it breaks up above them, and you're in a bull market. Breaks down below them here in 2012 was that. Breaks down below them. So we're looking for that break up above them over here, and that'll confirm that we're in the bull on the gold miners. So so those lines are going to be really important lines to keep our eyes on, aren't they?
Yep.
Let's move on and have a look here at this analysis. So this is just greater detail also on the Amex Gold Bug Index.
Analysis, yeah. So it's focused on the 45-month cycle,
Yes.
and trying to visualize that cycle. And it's again, I have to compliment you, David, on these cycle lines, because it really helped me visualize
Yeah.
the cycle, and particularly not so much the troughs. I've always had success understanding, identifying the troughs, but I've always struggled with the peaks
Right. Right.
and when to expect a peak and when to take profits. But if you study this chart and you start with the low in 2000 and you see we've identified the trough, so the solid line on the cycle line, the orange line,
Yeah.
in 2000 gives you the low.
Yes.
And then if you follow the cycle lines for the dashed cycle, which is the peaks analysis cycle line,
Yeah.
you arrive at your peak in 2004, early 2004.
Yes.
So you've basically captured the entire 45-month cycle. The same occurred in 2005. If you draw from the low in 2005,
Yeah.
and then you see that low relative to the peak that arrived in March of 2008.
Yes.
So again, you followed the cycle, you follow that cycle from trough to peak.
That's right.
And then the same thing occurred in late 2008 into 2011.
Right. Yes.
And then finally you see the difference, and you see the problem in the bear market. We made that peak, and rather we made that trough in 2012, which was a 45-month cycle trough, and then it failed.
Yes.
And you're just looking at a market that was making lower highs and lower lows, and then the next 45-month cycle peak came at a much lower price.
Right.
So now we look at what's ahead of us, and we see the important low in early 2016 for the miners.
Yeah.
So we identify that trough, and then we see the peak, projected peak, which is the dashed line, and that's out at least a couple of years from here.
Yes. Yeah. Yep.
Right?
So we're looking for that move out. Yeah.
And then of course, that matches up with the projection. If you look at the top of the chart for a peak to arrive, again, this is a 7.5-year cycle peak.
Right. Yep. So we're looking for that peak.
So that's that's a good, it's a good view of that cycle, and again, you can talk to the Hurst things such as the breaks, the buy signal and early this year that gave you the confirmation that the larger cycles bottomed, etc.
That's right. Yes. Yeah. Yeah.
All right.
There's a quick little.
So the nice thing about the cycle lines is that especially for people who are learning the method, it's a bit of a Hurst cheat, but at the same time it just helps you understand the cycles and visualize them, because that's one of the most important things to do, is to try and get a picture of the market and what it's going to do.
Yes. Yeah. Yeah, that's right. It's just another way of being able to visualize what your analysis is telling you. I'm pretty used to looking at diamonds and triangles and so forth as you are, but the cycle lines are really helpful just to highlight some interesting points. There's something I'd quickly like to say about this 45-month VTL over here, this downward dashed line, which of course should join two consecutive peaks of the 45-month cycle, and you can see it's connected to that peak, and the next peak is over here. And sometimes we get emails from Sentient Trader users asking why is the VTL not touching that peak there? And the reason is because of the second validation rule that Hurst defined when he was defining what makes a trend line a valid trend line. The second rule states, I think it's the second rule, I stand to be corrected, but the second rule states that the VTL needs to be drawn in such a way that it does not cross price movement. In other words, the price does not breach the line. And so you can see this little peak over here. If if the VTL was drawn in such a way as to connect this peak up at the top with this peak all the way down here, then it would breach price at that point over there, and in 2012, and so as a result, Sentient Trader has shifted that VTL line up a little bit. That clarifies why sometimes your VTLs don't actually touch the troughs or the peaks. It's because of rule number 2. So
right.
So should we move on? What we're looking at here,
Yep.
in the greater detail, of course, is for the trough to form soon, and then for a move up. So we're getting the same message, that we're looking for support to form, and then we're looking for the move up. And here's an even more detailed chart and showing us the FLDs.
Right. The same FLDs, yeah. And again, you can see how really, just from a Hurst point of view, that 45 cycle should giving us support here in the coming months. And I don't know if you've noticed this, David, but when a market turns bullish, the larger FLD, like the 45-month FLD, it will actually drive down and away from price. And then the other FLDs should be supporting price and moving up,
Yes.
so that they're all eventually able to trend together on the upside, and then the opposite would happen on the downside, right?
Yes.
So this period here between now and say the early part of next year is quite important time for the sector, and for anyone that's looking to get bullish on the sector. We need to find support here, and as I was saying with the UE and the gold miners, we could still find at least under 5 to 10% down before we start to see signs that we're actually bottoming, and then we really want to see some support, particularly I think in November. I think we need to see some support come in November and then a bounce, because if you look at the peaks analysis, we're due at least a 17-week peak, and then we probably come back down again, but then we would start cycling up into the next leg. That's sort of roughly what should be happening.
Yes.
And I guess we'll see, but I think to give short-term projections in terms of what price will actually do here, I think is unrealistic. But you can see from a Hurst point of view that we're coming down into some pretty big support here, or important support.
Right. Yeah. So these FLD lines are definitely the lines to be watching over the next few months, looking for some support at those lines. I see a question from Najmuddin. Najmuddin, I'll come back to that. It's about the VTL. I'll come back to that in just a minute. Let's finish this discussion about the gold miners, and then I'll come back to the comment about the VTL. Yeah.
All right. Yeah, I think I know where that's going. Okay, so I think everyone should be aware that my expectation is there's not likely to be a V bottom here,
right.
But probably consolidation and a low forming, and I think once all the bullish sentiment's taken out of the sector, I think this is where I'd be looking for the low to form, really pretty much in and around the 45-month felt should be providing support very soon.
Right. So this orange FLD is
right.
really where we're looking for the support to form. Yeah. Let's move on
and then I think the next point is targets.
Targets, yes.
If if we truly have a bullet, and if this market does act according to the way we think it might, we should be forming a low here by the end of the year and around the end of the year, And then an obvious target is formed already with the 45-month FLD cross.
That's right.
And
Yeah,
I've given a conservative kind of target because it's the first cross. It's not always
it's the first
necessarily
cross, yes.
the right one to use.
Yeah, yeah.
It could be a little bit higher. Your target could be perhaps 20 points higher. And then also bear in mind that very large cycles are involved. So this is the minimum target we'd expect.
That's
and if
right.
bullish, we would
Because you've got support
likely
from the
exceed
longer
it,
cycles. Yeah,
right?
yeah. So once the gold miners find support
So
somewhere here, we're looking for a move, really right up to
yeah.
this level at a minimum. Yeah.
And if you look at analysis down below, I have a 33-month cycle that kind of failed. I was looking for that to be some kind of a low and a good bounce, which really didn't happen. I don't know if you can see that very clearly at the
Right
bottom.
over here, yes.
Yeah, the light diamond. So Sendian hasn't committed to that, but in
Yes.
past bull markets, that has been a pretty good low forming there, and it's coming and maybe comes in late and it shows up late.
Right.
And then there is the next cycle up, the 17-week cycle that is now due here into November. So
Right.
that's
Yes.
what's reflected in this analysis. So it's a little unclear in terms of which cycle is doing what.
Right. Right.
And I would say that that's where the composite line actually kind of again helps you visualize, okay, what all these different cycles are trying to do, or what's the sum of the cycles really
Yes.
in this
Yes.
situation. And the longer cycles are bottoming and are pointing up, but it's the shorter cycles that are trying to sort themselves out.
Right. Right.
Right?
Yeah. So that composite line is showing a bit of sort of up and down bouncing here, coming into
Yeah.
a bit of a sort of a declining wedge, and then bouncing up at roughly the level of the 45-month FLD. So the composite model line is expecting the same thing that we're expecting, looking at the analysis.
Yeah.
Right.
And always the caveat is that the composite line is only as good as your analysis.
Well, that's always
Right,
the
David?
problem. Yes, that's right. That's right. That's why I'm always very careful to say, the composite model line is not going to tell you the future. All it's doing is it's showing you another way of looking at your analysis and understanding it. So, if your analysis is wrong, your composite model line will also be wrong. Which is why
Yes.
it's really useful to really study an analysis and question it. So let's have a look at the gold
Right.
and silver secular peaks. This is the much longer term cycles.
Right. So again, I like to follow longer cycles to try and understand, what the next largest cycle up might be doing, and what might be there. And so there are potentially two that we could talk about.
Yeah.
But I think the first thing we should discuss is, what are secular peaks? And in my research, secular peaks are major trend changes. They're climactic peaks. And for gold and silver,
Right.
for example, we saw in 1980 and in 2011. They were major peaks. Previous ones to that would be 1920 and somewhere around the late 40s, potentially 1947. And what that leads to is significant correction. So in the case of gold and silver off the 2011 peak, we had almost just a little over 50% correction in gold and a 75% correction in silver. So, and of course the gold miners, most of the indices corrected by 80 to 85%. So a significant bear market. And so these peaks are separated by roughly 25 to 30 years. And I'm not going to get into the detail, but I can tell you that this is way on the side, but the sunspot cycle actually coincides with a lot of those peaks.
Okay.
and
Wow,
which
that's
is really
interesting.
kind of interesting. Yeah,
Yeah,
I'm not going
yeah.
to get into that. But
Sounds what.
the interesting thing, though, is this 25 to 30 year cycle or period or interval would potentially give you a 2-to-1 harmonic, and the next larger cycle would be a 55 to 60 year cycle interval.
Yeah.
And the interesting thing is that uh, actually just coincides with the contractive wave periods of roughly, I guess you'd say probably 50 to 60 years. So I'm not saying that they're directly tied, but they do coincide,
Yes,
and they
yes.
are related in certain way.
Yeah.
So what it means for us, though, in this space is that if we use this analysis, and we'll show something on the long term for silver, but the next major peak should be in 2040
2040. Yeah.
for both gold and silver. Yeah, which
So,
is quite a ways down the
yeah, we're
road.
looking at 24 years to
Yeah,
to get into
yeah,
it. Yes. Okay,
yeah.
great.
So I think why I want to mention that is there's a lot of gold analysts and a lot of newsletter writers will say, oh, gold is going to be 2,500 next year and stuff like that. That is just garbage.
Right.
There's just no way that's going to happen. Like it will eventually, I think, in this market, but there has to be a flow and a natural progression in the cycles before you even think about getting any kind of a market like that.
Yeah, yeah.
So why don't we have a look at I think it's silver, right? The next
Yes,
chart,
the next show. Can I
the
confirm you are
long-term
seeing these
view.
slides? My system shows me that it's showing a title. Are you seeing these slides, John?
I am.
You are.
I
Okay,
hope
good.
everyone else is.
Well, I think that means everybody else is.
Yeah, after an hour plus.
Yes, Mike
certainly
Richard
hope
says
so.
yes. Okay, fine. My system is showing me a very strange preview. Okay.
So this is a chart courtesy of Charlotte again. They keep some really good long-term data, and this is not a sentient analysis. This is an eyeball analysis, which
Yeah.
for all us Hurst analysis is the most important analysis sometimes.
Yes.
Is what we see and trying to interpret the cycle shapes and the patterns and the peaks and the troughs. And in the case of silver here, we seem to have some very important cycle peaks about 50 to 60 years apart.
Right.
And the 1981 and the 1921 is highlighted. And even going back, there's one in the 1860s, like 1865. So you can see, where I'm coming from that cycle period. And then the half cycle to that is the one that we've been talking about, which is the 25 to 30 year.
Yes.
And so we in 2011 we saw one of those. Okay, we saw a 30-year cycle peak in 2011.
Yeah.
There was probably one in the late 40s
Late 40s. Yeah.
that gave you some kind of a peak. So where am I kind of going with this? Well, first of all, because we saw such a large cycle peak, we don't know what the market's going to be like for the ensuing 10, 15-year period. That's the first point. It's not bullish market that we saw for the last 10 or 15 years. Then the second thing is if you notice in the 40s and into the 50s, we had a retest, and then we had a sideways market for a number of years. I mean, we could be in for a market like that, or we could be in a very bearish period for the metal like silver. Can be very bearish after this these 30 and 60-year cycle peaks.
Right.
And I don't think that's going to happen, but I just I'm aware and I'm cognizant of that possibility.
Yes.
I actually think that we're in a more bullish long-term phase of the market, something that will be similar to what we saw from the late 40s into 1980. I think it's
Yes.
going to be that kind of market, but it's going to take a while before the real run in the metals manifests. Say in 2030 and beyond.
2030.
So we have a
yeah.
period here that will be a little bit of an unknown. I don't know if you follow me in terms of my thinking, David.
Yeah. Yeah.
Right.
So following these
And
major peaks.
so
Yeah.
yeah. So, and what's not shown there is that silver corrected to $13, so it's already had a significant pullback. But that doesn't predict anything in terms of what it might do over this next 14.5-year cycle.
Yeah.
Right? And if the market is really bullish, then I would expect silver to retest its high at $50 within this next cycle, this next 10 years, if it's bullish.
Right.
If it's not, it could be very much a sideways, it could be very much a sideways market.
Yes. Okay.
And so I think silver is an important component of the sector to follow.
Important market to look at.
And to give you a read of what might happen overall.
Yeah. And you have an interesting, is it the next slide, an interesting comment here about what could drive a bull market. Yes.
So silver, silver really is it's a metal that's consumed, and unlike gold, the industrial applications for gold are very small, but it's more investment. But for silver, it really requires a major industrial application, and so silver lost its major use, which was film. Over the last many decades, it was an application that slowly dwindled, and now silver needs a new application to drive it into its next secular move, if there's going to be one. So again, this is why I say you got to watch silver. You got to understand what it's doing, and it could be that solar, for example, could be the one application that there could be other emerges, because silver has some interesting properties, right? It's got some good conductivity and thermal properties. So that's why the potential is there. And I guess in my conclusion, as I say that we have to watch silver, and if it really should retest its 2011 high, it's at $50 within the next decade if it's bullish.
Right.
And that I don't really think the sector is going to do much unless silver does that. If silver doesn't really do much here in the coming years, and you can tell the way it's acting, then we're likely to have a pretty quiet sideways type of market in this space, tradable, but I'm not sure that it'd be all that bullish. So time will tell.
Okay. Fantastic, thank you. So let's, there's one final slide, an interesting quote from Mark Twain. Let's take a look at that.
Oh yeah, it was my favorite.
Yes.
And so it's a motto I've used at some of my blog posts and some of my forum posting, and that is what it's saying here: by the law of periodical repetition, everything which has happened once must happen again and again and again, and not capriciously, but at regular periods, and each thing in its own period, not another's, and each obeying its own law. And so this is Hurst.
That's what Hurst is all about. That's right.
Yeah. Yes. What it's saying is that each instrument, each market has its own behavior, does its own thing, marches to its own tune, and in a regular way. And you're there to try and understand what that's doing and what that is. And this is, to me, this is a perfect kind of description of that idea.
Yes, absolutely. Right. Well, John, thank you so much for joining us and sharing your views about gold. It's been fascinating as always. I see a few questions there. Faribors is saying, can you please let us know where to find your blog or where you post, John?
Well, I think a lot of what I post is actually now in Hurst cycles.
We're putting it on Hurst cycles.
I make some comments at Traders Talk, for example, but I think most of my analysis, the thorough analysis, I post on Hurst cycles.
HurstCycles.com. I hope I've spelled that correctly. Yeah. So if you go to HurstCycles.com, you can see the analysis that John's posting at the moment, and
Maybe before we forget, we should go back to Najmuddin's question
Oh,
or
to
point
Najmuddin's
about,
question about the VTL.
yeah.
Yes. Let me see. Let me see. I have your charts here, and let me just show you something about this VTL. So Najmuddin asked whether the fact that the VTL gets moved by crossing price, whether that doesn't invalidate it, because the VTL, the first rule of the VTL, is that it must connect the peaks, the two consecutive peaks of a particular cycle, or two consecutive troughs of a particular cycle. So here you can see, in fact, I think it's the same chart, or a very similar chart to the one we were looking at a moment ago when this subject came up. And here you can see the VTL for the 45-month cycle, the downward pointing VTL, which must connect two peaks. So and must connect two consecutive peaks. That's very important. You can't sort of skip a peak in the middle. So the first rule states that the VTL must join two consecutive peaks. So here is the one peak, and here's the next peak, which is right down here. So that would mean that the VTL needs to be drawn like that. I haven't really done it properly, but it should touch that peak, and it should touch that peak. However, Hurst then states in his second rule that the VTL must be drawn in such a way that price does not, I can't remember the word he uses, but price cannot cross that VTL. And you can see this white line that I've drawn, which is a potential 45-month VTL, is crossed by price over here. So the way that I interpret Hurst's rules for validating valid trend lines is that I need to find a line that joins these two peaks, but it needs to be adjusted in such a way that it isn't contravened or crossed by price. So because it's being crossed by price over here, you can see what I've always done, which is what Sentient Trader does, which is that it simply moves that line so that it obeys the second rule as well. So you start off with the first rule. You want to connect two consecutive peaks. Then you fulfill the second rule, which is that it cannot be crossed by price. And so what Sentient Trader does is it moves that VTL upwards. As a matter of interest, why does it move it upwards instead of? Let me just clear this, and I'll show you what the other option is. The other option, of course, is that it starts here, and it goes that way. So why has Sentient Trader moved it up like that? Two reasons. First of all, because the sort of crossing of price occurred in the first half of the line, if you like. It occurred early, so it's adjusting it. But the other reason is because this VTL gives us important information. When this VTL is crossed, it tells us that a trough of a longer cycle has formed in the markets, and if we bent the VTL downwards to be along that white line, then we would have received that confirmation much earlier, which might be true, but the danger of that is that if that VTL is drawn incorrectly, then we are working with incorrect information. So that's why Sentient Trader has adjusted it in the way that it has. I hope that answers that question, Najmuddin. That's my interpretation of those rules. I know that some Hurst analysts do differ in their interpretation of those VTL rules. There are only 3 of them, and they seem strikingly simple when you first read them, but when you start getting to grips with the details, there are a few little slightly complicated things. So I'm going to wrap things up here. Thank you once again, John. Thank you very much for joining us and sharing your analysis of gold and the gold miners. Thank you to everybody else for joining us. Thank you for being here. I look forward to seeing you at our next webinar in 2 weeks' time, and I wish you, in the meantime, of course, profitable trading.
Thank you. Thank you very much.
Thank you, John.